In today's video, I'll be reviewing a trade setup I took on Eurusd using the strategy that I've been sharing with you guys here on YouTube. Basically, I'm going to show you how you can use your technical analysis to understand the direction of the news. So sit back and enjoy this video. Hello traders, what's good? It's Mark out here and welcome back to my YouTube channel. If you are new to this channel, do well to subscribe, turn on post notifications so that you get notified anytime I post a video content like this, and also do well to smash the like button because when you do, it helps the algorithm take this video to other traders. Always let the algorithm do its shit, you get me? Probably you should know by now that I trade ICT's concept, and for sure you know that ICT's concept is already making wave in the trading industry. As I always say, with ICT's concept, you know what really moves the market and you would understand how the forex market works. What I came to understand in trading is that the lines that we draw out on our chart, the trend lines that we put out on our chart, is really not what makes price turn. Yeah, for sure it could be that when price gets to the third touch it reverses, but do you know the underlying factor that makes price turn at a particular level? That's the reason why ICT's concept is here, to explain the in-depth reasons why a market is turning from a particular level and why it's actually reversing from a particular point. You get me? ICT's concept deals with pure naked charts. You don't have to box your chart with anything. You can analyze the chart by just looking at the candlesticks without drawing out any tools, without doing anything on the chart. The tools we pull out to use as smart money traders is just to mark out important levels that we take note of. You get me? Those tools basically don't contribute in making the market turn. We are just using it to understand where a particular level is in the market. So what really made me start up this channel? What made me start up this channel was because of the people I introduced to ICT's concept, and they still found it very difficult to understand its concept. So I had an idea of just starting up a YouTube channel where I could be explaining ICT's concept the way I understand it. And I've gotten a whole lot of people saying that I simplify ICT's concept. That's why this channel is here, to simplify ICT's concept for you. Now, I'm not trying to change anything. As I always say, I don't have the strength to change anything. I'm just trying to simplify ICT's concept to the barest minimum. You get me? Shout out to Michael. I don't know, I always feel like giving him shout out in all my videos. You can see I make use of analogies so much just to relate ICT's concept with real life stuff. That's why this channel is here, to simplify ICT's concept to you. Without further ado, let's dive into the chart so I can explain the trade setup that I took yesterday using ICT's concept and also with the help of CPI. Alright, so we are here on the chart and this is the daily time frame on Euro USD. I do make use of the higher time frame first to understand the logic and understand directional bias. The higher time frame is basically used for directional bias. Your higher time frame should basically be used for directional bias. Once you understand your directional bias, then you can always move into the lower time frame to look for your entry setup. Now, this is the logic, this is the structure that I want you to understand. First, you understand directional bias, and then second, you look for setups and entries in accordance to that directional bias. So you don't just wake up in the morning and then jump into a trade setup. No, what you have to do is you understand the directional bias and know if you are going to be bullish today or you are going to be bearish today. Understanding if you are going to be bullish or bearish today helps eliminate multiple trade setups in the market, because already you understand that in the forex market, in a day you can have both buy setup and both sell setup, but the trend of the market is going to help you understand which of the setup is good for that particular day. Now, how do I determine my directional bias? I still make use of ICT's concept to determine my directional bias. You get me? So what I do is, already you know that price moves from liquidity to liquidity, and you should also know that price moves from every area of imbalance to another area of imbalance, just rebalancing price action. You get me? So with that knowledge, all I have to do is come to my chart and mark out every liquidity area that I can find on the chart, and also mark out every point of imbalance that I can find in price action. That's the fair value gap. When you hear me say imbalance, it's fair value gap. You get me? What I got attracted to on this price action here was this gap here. I was basically studying what price was doing inside of this gap. A fair value gap is basically formed by three candlesticks. This is the first candlestick, This is the second candlestick and this is the third candlestick, right? So the gap is always formed in the second candlestick, you get me? The space here on this second candle is the fair value gap. This is yesterday, Wednesday, when I took the trade, but I'm doing my analysis right down from here because of this fair value gap that I'm seeing price action. So as you can see, price literally tapped the fair value gap, and you know that once price taps into a fair value gap, the next place that price most likely will be going to is liquidity areas or another area of fair value gap or another PD array. I also marked out this other one right here, you get me? So my expectation is to see price rally away from this fair value gap and to grab buy side liquidity, right? Price grabbed the first buy side liquidity here on Tuesday. Then on Wednesday, I expected price to come to this area. Why I call this place liquidity, these are areas where the retail traders will be looking to place their stop loss, and that is what attract price. This area in price action serves as a magnet. When you understand the logic of liquidity, you see that everything is more simpler to you when you trade. Now, what do I mean? Areas of liquidity and imbalance or fair value gaps, they act as a magnet to price. What do I mean as a magnet? Price get pulled towards this area on your chart, you get me? So they act as a magnet. So anytime you go on your chart, you always want to mark out areas of liquidity and fair value gap, because that is how you understand your directional bias. How? Because price will definitely get attracted to those levels. So understanding where price will get attracted to, where price is most likely going to go, gives you a sense of directional bias, right? So now what I actually did here, since we were here and this liquidity was yet to be grabbed, then this place now could serve as an area of attraction to price pulling up to grab that liquidity. Let me take this out so you could understand what I mean. Alright, so on a normal note, when I saw this graph, I was expecting price to come lower into this other fair value gap, right? So I was expecting price to do some sort of pullback, because after grabbing liquidity, you want to rebalance, do some pullback, then go back high. But I got to realize that Wednesday was literally CPI, and we could just see price rally high to grab this liquidity, because that's what the news is there for. This might get filled much later, but the liquidity is more stronger, right? Because that's what moves the market. Liquidity is what basically moves the market. So that was my directional bias on EURUSD. I wanted to see when is they going further during London session, come into here and then move price higher to grab this liquidity, or I just see price moving here straight. So now determining my directional bias is the range from here to here. The range from here to here was what I was looking to target with EURUSD. You can see that's a clean 88 pips for a day trade. So that was my directional bias to see bullish movement into this liquidity area. So let's move over to the 1 hour time frame. Alright, as you can see on the 1 hour time frame, it's pretty much simple. As you can see on the 1 hour time frame, this was the daily fair value gap that I wanted price. I really wanted price to come into this gap, but you know, you don't want to always force things in price. You always just want the candlestick to print out the story, and you just have to follow the story that price is printing, right? Now this was our first high on the daily time frame that got grabbed. I will just push this back, and then this is the initial target. This is where I want price to go, right? So this is the 1 hour time frame with the annotations already. As you can see, this is the previous day high, just slightly before the day closes. You have the previous day high, and I marked that out and extended that, and then this is the previous day low, right? You mark that out and extend it in price. This is what happens in the previous day. How do I know this? By marking out this using the period separator. The period separator is not really period separator, it's just a tool, the vertical line that I use. When you come here on your trading view, you click on this, and then you see the vertical line. This is what I use, the vertical line, and then you place it here where you can see the time is 0:00. That's midnight New York open. So you want to always annotate that on your charts to know previous day highs and previous day low for possible areas of liquidity, right? I also get to mark out areas of fair value gap, areas of imbalance in price action, right? So here I mark this out, that's a fair value gap there, and then mark this out also. That's another fair value gap there. So I'm just going to wait to see which one of them price is going to use, right? So let's go lower to the 15-minute time frame. Alright, so this is the 15-minute time frame, and this is the previous session low, which is the Asian low, and this is the previous session high. This is also a previous day high. So Asian high with previous day high is always a high probability level where you see this trade setup forms. It's not wrong to pick a sell setup here, but this only reduces your win rate because today you're meant to be bullish, right? But regardless, this is why I like this strategy. Even without a directional bias, you can literally take this trade setup. So far, all the confluences have met, right? So now we have a previous day and we'll just be waiting for the grab, and this is a cool entry model for London session. Once the Asian session is being grabbed during London, that's an ideal formation for London trades, right? If you are a London trader, this is an ideal setup for you. What I'm going to do is just play price down to New York because the trade setup was doing CPI. So this flag here basically signifies that there is news by this time. So it was 8:30 and I'm going to just play price down to this time before the news. Now this is the fair value gap that was disposed from the 1 hour time frame. These two fair value gaps, remember I marked them out from the 1 hour time frame, and I really favor this down fair value gap, not this one. So I really favor this one. So we'll just play price through down to New York session. Now, so as you can see, previous day high was grabbed, which was also previous session high, which is Asian range high. Now it was grabbed and then we saw displacement breaking market structure, right? So now what you want to do is, as a London trader, this is an ideal setup for you. Even if our directional bias for the day is bullish, remember we want price to come in here or grab here before we are bullish. You can use that initiative from here to take price to here to take your profit as a London trader, right? So with that in mind, you've seen that this is going lower, so you would have taken the initiative of this previous day high being grabbed. Remember, the setup normally forms after a previous day high has been grabbed or previous session high has been grabbed. So in here there will be some sort of fair value gap. Let's just go to the 5-minute time frame and then mark out the fair value gap. As you can see, this is the fair value gap that I would have used if I was to take a sell trade, but I didn't focus on the sell setup because my directional bias was bullish. That doesn't mean if you see a setup like this you shouldn't take it. So if you are a London trader, this would have still be ideal for your trade entry, right? So this is the fair value gap you would have taken. You can see that this is when price tapped in, and then this is where your entry would be, your stop loss here, and then you target 1:3, and that's like a cool RR for this trade. Let's take this off and let's just keep playing price to New York session. Alright, so we are at New York session here, this line here. So I'm going to just take this off, and then we are New York session, right? So I'm going to delete this because this was violated. I really didn't trust that, and now price has tapped into this other one. So it's New York, and you're going to take Asian range low out because we've passed London. The Asian range low and the Asian range high is only valid for London session trade. So after London session trade, you want to move your previous session highs and lows down to London. So this was previous session low, this was London low. It was being grabbed during New York, and this is an ideal setup before any bullish move. You want to always see price grab sell side liquidity before moving higher, right? So after seeing this graph here, I was just waiting for a displacement that is going to break market structure. So after this graph, I want to be seeing a clean break of market structure. You can use here, but where it will be more cleaner will be here for me. I would have loved to see here being violated, so I wanted here to be violated. So if we keep playing price, as you can see, price gave us a new level to work with. So if you mark this out, we just be waiting for a break of that, then you find your fair value gap to take your trades. Now if you play this out, we had this, but it really didn't break, so I was waiting to really see that break on the 15-minute time frame, right? And we had this, right? So having this break, I was like, okay, in order not to miss this trade, let me go to the 5-minute time frame to see if I can see a fair value gap, right? Because we were really getting close to the news. We're really getting close to the news. If I'm going to mark the 8:30 here, we're one candlestick away from the news, and I didn't have a fair value gap to take my trade. So what I wanted to do was, in order not to miss this, I scaled lower to the 5-minute time frame, and on scaling lower to the 5-minute time frame, everything was clearer to me, right? So what you can see here was a grab of liquidity, a grab of previous session low. This was London's low. it grabbed, and then it broke market structure, which was here, and then it left behind a fair value gap that was already tapped into. You get me? It was already tapped into. So what did I do? I had missed this entry here because I was still on the 15-minute time frame. My entry was basically here when I saw this, right? When I saw this is when I took my trade, because already, if you are to measure from here to here, from where price was to my entry, it wasn't up to 2 pips. So I actually took price there and then kept my stop loss here, and if you see here, it was just basically not even up to 10 pips, right? So this is where I kept my stop loss. I took the entry, and this is this entry setup forming right inside a 1 hour fair value gap. This is another high probability trade setup. Once the setup forms inside a higher time frame fair value gap, so you can see it came deeper into the higher time frame fair value gap, broke market structure here, then dropped the fair value gap, came back down, filled that, and then that was the trade setup. Now all I'm just waiting for now is for CPI to push price higher, right? Now there's every possible way that CPI can push price lower to grab my stop loss, but here I was just allowing probability to work in my favor, right? So if you want to target, remember you always want to target 1:3, right? And knowing how volatile CPI is, my trade could get past 1:3 easily, right? But I'm just going to stick to the 1:3 rule, right? So this is where my take profit was, on a 1:3. So if you just play that out, the next candle is going to be the CPI candle, right? And then that is what I had on this trade setup. With just one 5-minute candle, I had smashed a take profit using this trade setup. As you can see, a very beautiful, wonderful trade entry here that I had on Eurusd using the strategy that I've been showing you guys on YouTube. Don't just trade this strategy for the pattern's sake. Go in, understand your higher time frame direction. It's going to be more easier for you to smash TP when you are following the trend, when you're following the direction of the market. This was the beautiful entry setup that I saw on Eurusd, and with the help of CPI, this trade setup smashed take profit. It printed out exactly the strategy and the setup that I've been discussing on YouTube. Now, if you don't understand this strategy fully, check my last video on my channel. That is where I went in depth to explain the concept behind this trade setup. Remember, you don't just want to be trading this setup just because of the pattern, else you turn into a retail trader. You get me? What you want to do is you want to add up higher time frame and smart money logic before you can take the trade setup. You get me? Alright, so I had promised on the channel that I'm going to show you a trade setup that normally forms after every major news. After every major news like the NFP or CPI, we usually have a continuation fair value gap that's being printed on the chart. So alright, this is the candlestick that smashed take profit, right? So if I take this out and I play price again, the next candle that forms always gives a chance for a fair value gap to be printed on the chart. So as you can see, the space from here down to here, all this gap here is a fair value gap. But here is the thing, this fair value gap is very much big for you to take your trade setups, right? It's very much big. So what you are going to do is, after the news, you measure out this fair value gap, then you take out your fib tool, and then you measure from this high down to the low where the fair value gap started, right? You want to take your entry from 50% of the fair value gap, right? So if you measure from the 50% of this fair value gap down to the candlestick here, the second candlestick that formed the fair value gap, or the first candlestick, this candlestick here, if you measure it, there is not even up to 20 pips, right? So that's where your stop loss is going to be. And in a continuation fair value gap, you don't always have to put your stop loss below the first candle that formed the fair value gap. You can always leave it on the second candle, the candle that has the fair value gap itself, right? This is not a reversal fair value gap like this one, because here price was coming lower, and this is a reversal fair value gap. Right now, this is a continuation fair value gap to keep taking price higher, right? Remember, our higher time frame level is here, right? So we still have a chance to take price higher. So where do we enter? You always want to enter inside of the fair value gap printed after the news. If you want to go long, you place your entry here, and then your stop loss is going to be below the second candle, right? And then your take profit is obviously going to be here. So that's your take profit on this trade. So now if you just play price through, so what happened here was price literally tapped into the fair value gap. but it didn't come to the 0.5 level, and we had price rally higher to smash take profit, right? Price didn't come here. Now majority of the time you might see this happen. This is more like a missed trade, right? So taking trades from here after NFP is not ideal because your SL will be very loud and your risk to reward won't be okay. So there are scenarios where price will definitely come below here before plumbing higher. It was just that the higher time frame draw on liquidity was really attracting price, and price was basically leaving gaps on fill without filling gaps, right? When you see gaps being on fill, like left on fill like this, it basically means that price wants to immediately get to the liquidity area, right? So this is a setup you can basically use immediately after NFP or CPI. There's always a fair value gap you can always look to take your trades from. So this is basically the setup that you can use. This setup doesn't really form all the time. Sometimes you may just go straight up for your stop loss, right? And also you want to be staying out of NFP or CPI if you don't find a valid technical reasons for you to take this trade. Normally I basically don't take trades during NFP and CPI, but when I find my technicals working out like this beautifully, some days I just allow probability to take chance. Though I know I'm not supposed to be taking trade setup during CPI or NFP, but some days it works out perfectly like this, you get me? So these are just the days that probability works in your favor, right? So if you love content like this, do well to subscribe, turn on post notification, and make sure you like this video. This will help you to take this strategy to other traders as well. Drop a comment if you love this video, and if there is any concept you want me to simplify here on this channel, do well to drop it on the comment section. And also make sure you join my Telegram channel. Check the description below. You can follow me on all my social media handles. The description is also below there. Get me? In my Telegram community, I share live helping nudget, and I also go live with the traders in there for free. Make sure you join my Telegram channel to stay updated. So until next time, peace out.